You're lying in bed at 3 in the morning, doing math that keeps changing no matter how many times you run the numbers. Your portfolio was at 50,000 euros last month. You checked it yesterday and it was at 42,000. 8,000 euros just vanished. You tell yourself it's temporary, that markets always recover, that you're diversified and disciplined. But there's this voice in the back of your head asking what happens if it keeps falling. What if it drops to 30,000? What if your job disappears right when you need to sell just to pay rent? And that voice gets louder every time you refresh the screen and see more red. This is the moment that separates people who build wealth from people who lock in catastrophic losses. And most people have absolutely no idea which side they're on until it's too late. My name is Leo. I learned investing in the United States, then moved to Europe and spent 9 years figuring out what actually works here, which means I've seen every psychological trap that makes people panic and sell at exactly the wrong time. If you're serious about preparing for the next market crash, and trust me it's coming, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you could be the difference between surviving a crash and getting destroyed by one. Here's what nobody tells you about market crashes. They're not rare disasters. They're not once-in-a-lifetime events. They are the default state of investing in stocks. And if you don't understand that at a bone-deep level, you're going to make expensive mistakes. Most beginners treat crash risk like getting struck by lightning. 1 in a million odds. No preparation needed, just hope it doesn't happen to you. That's exactly backwards. Market crashes are like rain. They're frequent, they're predictable, and with simple preparation, they transform from a disaster into an inconvenience. Let me give you the empirical data that should fundamentally change how you think about this. Over the past 50 years, global stocks have delivered 9% average annual returns. Trillions of euros in wealth creation. Life-changing money for anyone who stayed invested. But that journey was incredibly bumpy. 75% of months, your portfolio is below its all-time high. 75%. The median drawdown from peak is 8%. A quarter of the time you're dealing with drops of 17% or more. And 10% of the time, meaning one full year out of every 10, you're sitting on declines of 29% or worse. Your 10,000 euro investment becomes 7,000 euros. And you're expected to just sit there and do nothing while the financial media screams about the end of capitalism. Now here's the thing. If you've made it this far in the video, you're already thinking differently than 90% of retail investors. Because most people don't even want to acknowledge that crashes happen. They invest with their fingers crossed, hoping the good times last forever. That strategy works brilliantly right up until the moment it destroys you. So let me show you the 11 steps that will prepare you for the next crash. Not if it happens, when it happens. Whether it's an artificial intelligence bubble popping this year, a banking crisis in 3 years, or some catalyst we can't even imagine yet, these steps will keep you solvent, sane, and positioned to profit while everyone else is panicking. Step 1. Plan for crashes as normal. Not an aberration. Not bad luck. Guaranteed over extended periods. There's a survival statistic from airplane crashes that always stuck with me. 80% of survival success comes down to preparation. People who've mentally rehearsed what to do in an emergency survive at dramatically higher rates than people who freeze. The same principle applies to investing. The investor who's mentally prepared for a 40% drawdown behaves completely differently than the investor who thought it could never happen to them. Step 2. Build a safety cushion. This is non-negotiable. You need an emergency fund in a bank account that is never ever invested. I cannot stress this enough. Let me tell you about a Wall Street analyst who learned this lesson the expensive way. 2009, markets in freefall. He loses his job. No emergency fund because he thought job security at a major firm was bulletproof. He's forced to sell half his portfolio to cover 6 months of living expenses. Locks in massive losses at literally the worst possible moment in market history. If he'd just had that cash cushion, he could have stayed fully invested and recovered everything plus gains when the market bounced. Some investors maintain extreme 2 to 3 year expense cushions specifically so they can hold 100% stocks without ever worrying about being forced to sell. Most Europeans should maintain at minimum several months of living expenses in cash. Figure out what lets you sleep at night. Step 3. Understand your actual risk tolerance through brutal visualization. I want you to close your eyes for a second and really imagine this. You have 50,000 euros invested. You wake up one morning and it's now worth 30,000. 40% loss. The news is showing images of bank collapses or war or whatever crisis is driving the panic. Your spouse or your parents are asking what happened to the money. What's your gut reaction? If it's disaster, if it's, I can't believe this is happening, if there's any part of you that thinks you need to sell to protect what's left, then 100% stocks is completely inappropriate for you. This scenario is uncommon, but it has occurred multiple times and it will occur again. You need to know now, not when you're down 40%, whether you can handle it. Step 4. Adjust your risk based on age and time horizon. Here are the historical loss expectations you need to memorize. 100% stocks could lose 40 to 50% in a major crash. 75% stocks, 30 to 40%. 50% stocks, 20 to 30%. Now, lose here means temporary if you're holding diversified index funds or ETFs that will eventually recover, but only if you stay calm and avoid expensive mistakes. And here's where age becomes critical. A 20-year-old watching their portfolio get cut in half has 30 years to recover. It's psychologically painful but financially manageable. A 65-year-old who just retired with half their portfolio suddenly missing, that's a catastrophe that might never get fixed. That's why you rarely see retired investors holding more than 50 to 60% stocks. The risk of being forced to sell during a crash when they need that money for living expenses is just too high. Step 5. Global diversification to avoid the return-chasing trap. December 1989. Japan. The biggest stock market in the world after 20 years of 15% annual returns. The media was praising unstoppable innovation. Japanese companies were buying Rockefeller Center and Hollywood studios. Everyone knew Japan was the future. And it became a trap for concentrated investors who earned only 1% annually over the next 36 years, while global stocks earned 8% and the S&P 500 earned 11%. This is the most prominent mistake beginners make, chasing recent returns. Now apply that lesson to today. The United States market has delivered 11% returns over the past 20 years versus 8.6% for global stocks. The US is now 61% of total global market capitalization. Many investors are claiming American exceptionalism justifies going all in on the S&P 500. Maybe they're right. Maybe that concentration will prove wildly profitable. But this video isn't about maximizing profits. It's about controlling risks. And S&P 500 concentration is quite dangerous. Harry Markowitz won a Nobel Prize for proving that diversification is the only free lunch in investing. It requires exposure to many markets, many countries, many currencies, many industries. Because that's what reduces the impact when one sector or region faces a major disruption. We're halfway through this guide, and honestly, the next section is where most investors fail. Not because the steps are complicated, but because they require you to think differently about what investing is actually for. Stay with me. Step 6. Optimize your portfolio to reduce personal stress. This is non-standard advice, but personally valuable. Investing never eliminates risk. You have to accept some risk to earn returns, but you get to pick which risks you take. If a particular risk causes you severe psychological stress, you can structure your portfolio to remove or reduce that specific risk. Example: maybe you're convinced there's an artificial intelligence bubble in US tech stocks. That worry keeps you up at night. You can build a portfolio that excludes expensive US tech by focusing on small cap stocks and international markets. You'll miss the upside if you're mistaken, but you'll sleep better. Frame this as optimizing for minimal regret rather than maximum profit. Because regret is what makes people sell at the bottom. Step 7. Do not sell during the crash. This is the most important guidance in this entire video. Investing is what's called a loser's game. You win not through brilliance but by avoiding mistakes. And selling during a crash is the single most expensive mistake you can make. It's incredibly difficult to resist when the market's down 50%, headlines are insane, and every instinct is screaming at you to protect your family. Especially if the crisis drags on for years with experts on television claiming this time is different and the market may never recover. Selling locks your losses permanently. It prevents recovery. So I want you to write this down today, right now, before any crash happens. Write this exact sentence. No, I will not sell during a crash. This is why I have my safety cushion. This is why I have a good portfolio with appropriate risk level and the right mixture of stocks and bonds. I am prepared and I will not panic. Having that written plan dramatically improves your ability to resist panic. The one exception to never selling is if you're retired and taking planned regular withdrawals. That's different. We'll cover that in step 10. Step 8. Rebalance during the crash. Let's say your strategy specifies 70% stocks and 30% bonds. Crashes typically shift that to something like 60% stocks and 40% bonds because stocks fall harder than bonds. This creates an opportunity. You sell some bonds and buy stocks to restore your 70-30 target. You're automatically buying stocks when they're cheaper. This usually works out very well. Step 9. Keep buying if you're not retired. If you're still in the accumulation phase, still adding money every month, the smartest move is usually to continue your purchases as stocks decline. Warren Buffett has this famous line, "Be fearful when others are greedy and greedy when others are fearful." Now the market might not recover quickly. It can keep falling for months or even years. So don't invest money you can't afford to risk. Certainly never touch your safety cushion. But maintaining your regular investment discipline during crashes is historically one of the highest return strategies available. Step 10. Reduce spending if you're retired. This is a completely different scenario if you're withdrawing money every month to live on. It depends on your withdrawal rate and the severity of the crash. If you're pulling 3 to 4% annually and the market drops 10 to 20%, you're probably fine. Keep taking your withdrawals. But if you're taking much more than 4% annually or facing a truly major crash, you need to seriously consider reducing your withdrawal. Even a 10 to 20% spending reduction dramatically lowers your lifetime risk of depleting your portfolio. Write a specific plan now. Something like, if the market drops 20% or more, we cancel the summer sea rental. Or we sell one of the 2 cars. Having that predetermined decision removes the emotional component when you're in the middle of the chaos. Step 11. Learn to invest before the crash arrives if you're a market timer. I know. You've heard a million times that timing the market doesn't work, and statistically it doesn't. But some people are so nervous about crashes that they stand on the sidelines waiting to buy stocks when they're cheaper. Over the long term, this averages to a losing strategy because you miss years of gains waiting for the crash. But if you're absolutely determined to try timing the market anyway, at least learn the mechanics before the crash arrives. Look at COVID in 2020. The market was only down for a couple weeks. If you were trying to learn how to open a brokerage account and place your first trade during those 2 weeks, you simply ran out of time. Plus, it's psychologically very difficult to press the buy button for the first time with real money when everything's crashing and the headlines are terrifying. Put some money in the market now. Get comfortable with the process of buying stocks or ETFs. Be ready when the opportunity comes. Though over the long term, the actually smart approach is to start investing now and simply continue through both up markets and down markets rather than trying to predict the timing. Now let me tie all of this together, because when you see how these 11 steps work as a system, everything changes. The real magic happens in your brain. See, most beginner investors operate in what I call panic mode. They invest when they feel good, when the market's hitting new highs, when their coworkers are bragging about returns. They sell when they feel scared, when losses pile up, when experts predict disaster. They're making every decision based on emotion. And the financial industry is designed to amplify those emotions because panic and greed both generate trading fees. The system profits from your mistakes. But here's what happens when you implement all 11 steps. You shift from panic mode to preparation mode. You know crashes are coming because you've studied the data. You have your safety cushion so you're never forced to sell. You've visualized the worst-case scenario and confirmed you can handle it. You've adjusted your stock-to-bond ratio to match your actual risk tolerance, not some theoretical number. You're globally diversified, so no single market can destroy you. You've optimized away the specific risks that would make you lose sleep. You have a written plan that says you will not sell. You know you'll rebalance to buy low. You're committed to continuing your regular investments or reducing your spending if needed. That investor, the one who's taken all those steps, experiences a crash completely differently than the unprepared investor. When the market drops 40%, the unprepared investor sees catastrophe. The prepared investor sees a temporary setback that their system is designed to handle, maybe even an opportunity. And that psychological difference determines everything. Because the investor who panics will sell. They'll lock in losses, they'll miss the recovery, they'll spend the next decade trying to rebuild from a fraction of what they had. The prepared investor stays calm, stays invested, recovers, profits. Let me give you a hard truth that might sting a little. If you're not prepared for a crash, you're not really an investor. You're a gambler who's been getting lucky. and luck always runs out. Think about the neighbor with the over-leveraged real estate portfolio who seemed like a genius in 2007. Where are they now? Think about the coworker who went all in on a single hot tech stock. How'd that work out? Think about the family member who pulled everything out of the market in 2009 to wait for things to calm down and never got back in. They missed one of the greatest bull runs in history. Those people all made the same fundamental mistake. They didn't prepare. They thought good times would last forever, or they thought they'd just figure it out when things went bad. And when the crash came, they made catastrophically expensive decisions in the heat of the moment. You're not going to be one of those people. Because you understand now that crashes aren't aberrations, they're features of the system. They're the price you pay for long-term returns. And with proper preparation, they transform from disasters into manageable challenges, even opportunities. Here's what I want you to do right now. Today, before you close this video, open a document and write down your crash plan. Start with your emergency fund. How many months of expenses do you have in cash? If the answer is less than 3, that's your first priority. Build that cushion. Then write down your actual asset allocation. What percentage stocks? What percentage bonds? Does that allocation match your real risk tolerance based on the visualization exercise we did? If you're not sure, maybe dial back the stock percentage until you're confident you could handle a 40% drop without selling. Write down your rebalancing triggers. At what point will you sell bonds to buy stocks? Write your commitment. The sentence I gave you earlier. I will not sell during a crash because I am prepared. Write down your spending reduction plan if you're retired. What specifically will you cut if the market drops 20% or more? This written plan is your weapon against panic. When the crash comes, and it will come, you won't be making decisions based on fear. You'll be executing a plan you created when you were calm and rational. Now I need to know what you want me to cover next. Market volatility, tax optimization for Europeans, the risk of currency fluctuations, how to pick the right index funds, whether real estate belongs in your portfolio. What's your biggest financial question right now? Drop it in the comments. This channel exists to give you straight answers about money that actually work in Europe, not recycled American advice that doesn't apply here. Your future wealthy self is counting on you to take this seriously. 10 years from now, you'll either look back at this moment as the day you decided to prepare, or you'll look back with regret at the crash you weren't ready for. Markets will crash. That's guaranteed. Whether you survive and thrive or panic and lose everything, that part's up to you. You now have the 11-step system that turns crashes from disasters into opportunities. The only question left is whether you'll actually use it.